report out this week shows that foreclosures are rising in South Florida. Last year, rents dropped in downtown Miami for the first time in years.
We are seeing some crazy things happen in Southeast Florida right now. And when I say Southeast Florida, I mean Miami-Dade.
There's a luxury condo tower in Brickell where 17 units are listed for sale right now. 17 in the same building at prices nobody's willing to pay. Walk through the lobby and you'll see the for sale signs stacked in windows like surrender flags.
Local budgets have been bloated beyond probably what we've seen in the mid-2000s. It's gotten that bad again.
Given the importance of this issue, we cannot afford further delay in moving this conversation beyond promises or generalities.
Units that sold for $850,000 in 2022 are now listed at $695,000. Still no offers, still no showings that lead anywhere. That's not a market correction. That's a market screaming for help. And it's happening across every single block of Miami-Dade County.
I believe we can find our way through this complicated problem.
Home values are dropping in all of these areas as we speak. We're seeing some of the biggest declines we've seen in over a decade.
In the last 90 days, something unprecedented happened in South Florida. For every 2 homes that sold, 3 sellers gave up and pulled their listings off the market entirely. They'd rather own an empty condo, pay the mortgage, pay the insurance, pay the HOA fees, and get 0 return than accept what buyers are actually offering.
What's happening is there's a competition, a race to the bottom by landlords who need to fill up their space and try to bring in some money to help them cover their monthly expense. As this occurs, this forces some people into a situation where they no longer have the opportunity to rent it because the rent will not cover the monthly expense. So what do? They list the property for sale.
Miami-Dade just recorded its first annual price decline in over a decade. Foreclosure filings are climbing at rates we haven't seen since 2011. Downtown rents dropped for the first time since 2016, and the governor called an emergency legislative session because thousands of condo owners are getting special assessment bills they literally cannot pay. The market that everyone said would never stop going up, it stopped. Hard. The Instagram real estate influencers who told you Miami was the next Dubai, they've gone quiet, real quiet.
You could see 3,600 home sales in the 3-county Miami metro in July 2025. That's down 55% from the peak 4 years ago.
But here's what nobody's talking about, and what makes this situation more dangerous than a simple crash. This isn't a crash. It's something weirder. Something we've never seen before in American real estate. It's a market freeze. Buyers and sellers stuck in a standoff where neither side will blink. And understanding why it's frozen, what caused it, and what breaks it will tell you everything you need to know about what happens next, not just in Miami, but in every coastal market in America. Let me show you the numbers that real estate agents aren't posting on Instagram alongside their Lamborghini photos. April 2025, Miami-Dade County, 19,319 active listings sitting on the market. 3 years ago, that number was 6,376. The inventory has tripled, while sales collapsed by 55%. Think about that ratio. 3 times as many homes for sale, half as many buyers willing to buy them. July 2025 closed with just 1,782 transactions across the entire county. To put that in perspective, that's fewer home sales than Jacksonville, a city most people couldn't find on a map. The median single-family home price dropped from $670,000 to $660,000. Condos fell from $480,000 to $460,000. Those sound like small numbers, marginal declines that don't seem catastrophic. But in Miami, where prices have moved in one direction for 15 consecutive years, where the entire economic development pitch has been built on appreciation, any decline feels like gravity suddenly working in reverse. But the really disturbing number, the one that should terrify anyone holding Miami real estate, is this: 59. That's how many listings get pulled down for every 100 that go up. The national average is 22. Phoenix, which everyone thinks is struggling, is at 37. Riverside, California, another supposedly distressed market, is at 30. Miami-Dade is at 59. Think about what that means psychologically and financially. Sellers are listing their properties, watching them sit for 30 days with no offers, 60 days with maybe one lowball they reject, 90 days with their agent begging them to reduce the price, and then they're pulling the listing. Rather than drop the price to where demand actually exists, they're choosing to pay their mortgage, their HOA fees that keep rising, their insurance premiums that doubled this year, and get absolutely zero return, rather than accept the market's verdict on what their property is actually worth right now. That's not normal seller behavior. That's not strategic.
That's denial at scale. And denial, in real estate markets, always ends the same way. Eventually, reality wins. The only question is how much pain happens before sellers capitulate. To understand how we got here, you have to go back to the beginning. Because Miami's collapse is only dramatic if you understand just how insane the boom really was. 2020 and 2021 were unlike anything South Florida had ever experienced. The pandemic hit, remote work exploded, and suddenly anyone with a laptop and a decent income realized they didn't need to suffer through New York winters or California taxes anymore. They could work from anywhere, and Miami became the anywhere everyone wanted to be. Wealthy retirees from the Northeast started buying sight unseen. Tech workers from San Francisco were wiring deposits based on virtual tours. Institutional investors, flush with cheap debt, started acquiring entire buildings. New York finance guys bought second homes they visited twice a year. Crypto millionaires were paying cash for penthouses they used as status symbols. Properties were getting 10, 15, sometimes 20 offers within hours of listing. Buyers waived inspections. They offered all cash. They wrote personal letters begging sellers to choose them over competing bids. I talked to one agent who said she had a client offer $100,000 over asking and still lost to someone who went $150,000 over. By 2022, the frenzy peaked. Only 6,376 homes available across the entire greater Miami region. A seller's paradise where inventory vanished within days and bidding wars erupted over every single listing. From starter condos to oceanfront estates, the median home price in the Tri-County region hit $540,000. Developers broke ground on 70 new condo towers. Banks were lending aggressively. Appraisers were stretching to distract prices. Local officials were celebrating Miami-Dade as the next great American boomtown, the city that finally rivaled New York and LA. Everyone from mortgage brokers to city planners to the governor himself was selling the same narrative. Miami real estate only goes up. Florida has no state income tax. The weather is perfect. The city is global. Buy now or get priced out forever. That narrative is what makes the current collapse so psychologically devastating, because it's not just money people are losing. It's the entire story they told themselves about why they moved here, why they paid these prices, why Miami was different. So what broke Miami? What turned a seller's paradise into a frozen wasteland where nobody's buying and nobody's selling? Most people will point to one event. June 24th, 2021, 1:22 a.m., Champlain Towers South in Surfside. A 12-story residential building collapsed in the middle of the night. 98 people died. Families were sleeping, and then the structure pancaked in seconds. The investigation revealed corroded rebar, crumbling concrete, water damage that had gone unaddressed for years, and a condo association that had deferred critical repairs for decades because owners didn't want to pay higher fees. Florida responded fast. The legislature passed sweeping safety mandates. Every condo built before a certain date now requires milestone inspections at 30 years, and every 10 years after. Every building needs fully funded structural reserves. No exceptions, no phase-ins, no grandfather clauses. Get it done or get the building condemned. The law makes perfect sense. Nobody wants another building to collapse. No reasonable person opposes structural safety. But the implementation, the timeline, the lack of any financial transition mechanism has been absolutely catastrophic for ordinary condo owners. Condo associations across Miami-Dade started receiving engineering reports with repair estimates in the millions. Buildings that had been operating on $300 per month HOA fees, where owners thought they were getting a deal, suddenly needed $50,000 per unit, $75,000 per unit. In some cases, $100,000 per unit or more in special assessments to bring structures up to code. And these weren't recommendations. They were requirements. Do immediately, or within 6 months if you're lucky. Pay or face liens. Pay or the building gets red tagged and evacuated. One building near Biscayne Bay sent the letter in February 2025. $75,000 per owner. 6-month payment deadline. No financing options provided. No alternative timeline. Just a bill. Within 2 weeks, 12 units hit the market. Desperate sellers trying to get out before the deadline. But here's the problem. Within 6 weeks, 0 had sold. Not one. Because Fannie Mae and Freddie Mac, the entities that back the majority of mortgages in America, stopped backing loans in buildings that couldn't prove full reserve funding and structural compliance. So now you've got owners who need to raise $75,000 to comply with state law, but they can't sell because buyers can't get financing. They can't refinance to pull equity because their building is flagged, and they can't afford to just keep paying because their insurance premiums just tripled. It's a financial trap with no exit, and it's playing out in hundreds of buildings across Miami-Dade County right now. In zip code 33131, downtown Brickell's core, more than half the condo towers now face some form of financing restriction. That means cash buyers hold all the power. If you need a mortgage, you're locked out entirely, and cash buyers know they have leverage, so they're offering 20%, 30% below asking, knowing sellers eventually have to accept. Let's talk about insurance, because this is where Miami's financial math completely falls apart, where the monthly costs become impossible for anyone earning less than six figures. In 2021, a decent homeowner's insurance policy in Miami-Dade cost around $2,500 annually, high compared to most of America, but manageable. By 2024, that same policy was $5,000. For waterfront properties or anything in a flood zone,
which describes most of desirable Miami, you're looking at $7,000 to $10,000 per year. Insurance carriers are leaving Florida entirely. Citizens Insurance, the state-run insurer of last resort, is overwhelmed and raising rates. The private carriers that stay are raising premiums 40%, 50%, sometimes 100% year over year. They're looking at hurricane risk, sea level rise projections, the cost of recent claims from Ian and other storms, and they're making a business decision. Florida is uninsurable at any reasonable price. So now do the actual math on owning a two-bedroom condo in Brickell. Real numbers, nothing hidden. Mortgage on a $500,000 unit at current 7% interest rates, $3,200 per month. HOA fees, which have been rising to cover higher insurance and deferred maintenance, $800 to $1,200 per month. Homeowners insurance, $600 per month minimum, $800 for waterfront. Property taxes, $400 per month. Utilities, $150 per month. Parking, $200 per month in many buildings. You're at $5,350 per month minimum. That's $64,200 per year after tax, just to own a 1,200 square foot apartment with 2 bedrooms and 2 bathrooms. Using the standard 30% housing cost rule, you need to earn $214,000 per year to afford that comfortably, and that's assuming no special assessments. The moment that $75,000 bill arrives, you either write a check you don't have, take out a personal loan at 12% interest, or you default. There's no third option. The people who bought in 2021 at peak prices with 3% interest rates could maybe make it work. But anyone trying to buy today at 7% rates with insurance at current levels, the economics don't work, unless you're wealthy enough that the monthly costs don't matter. Here's what's happening on the ground, the human stories behind the statistics. For the first time since 2019, more people are leaving Miami-Dade County than moving in. The population is shrinking. School enrollment is dropping in districts that scrambled to add capacity just 2 years ago when families were flooding in. The bright young professionals and remote workers who arrived during the pandemic are leaving for Nashville, Austin, Charlotte, Raleigh, and Tampa, where their dollars go twice as far and the insurance is half the cost. One couple, both teachers earning a combined $110,000, left their Coral Gables condo after their building announced a $40,000 per unit special assessment. They couldn't come up with $40,000. They couldn't get a home equity loan because the building was flagged, so they walked away, let the bank foreclose, destroyed their credit, and moved to Tampa. They bought a 3-bedroom house with a yard for less than their Miami mortgage payment and cut their insurance costs in half. Another family left after their monthly costs jumped $1,200 in 1 year. Their mortgage stayed the same, but insurance went from $3,000 to $7,000 annually. HOA fees increased from $400 to $650 per month to cover the building's insurance increase, and then a $15,000 special assessment hit for pool repairs. They didn't want to leave Miami. They had jobs, friends, roots, but the math stopped working. But the real story, the one that should concern anyone thinking Miami bounces back quickly, is who else is leaving. The institutional money. Wall Street firms and private equity groups bought thousands of Miami condos between 2020 and 2022. They were betting they could flip them for quick profits or rent them to remote workers for enough to cover carrying costs and generate returns. They were wrong on both counts. Title records from the second quarter of 2025 show LLC after LLC selling units in bulk across Brickell, Sunny Isles, and Edgewater. These aren't distressed sales, they're strategic exits. Firms looking at their portfolios, running the numbers on carrying costs versus rental income versus appreciation potential, and deciding Miami no longer pencils out. In one new tower on Biscayne Boulevard, nearly a third of pre-construction buyers walked away from their deposits rather than close on properties they knew they couldn't profitably rent or resell. They forfeited $50,000, $75,000, sometimes $100,000 deposits, because closing would have meant losing even more. When institutional capital leaves a market this fast, it doesn't come back for years, maybe decades. These firms have long memories. They'll redeploy that capital to Sunbelt cities with better fundamentals, lower risk, and higher returns. And without institutional buyers providing a price floor, Miami's market has to find support from retail buyers alone. The governor, who spent years celebrating Florida's real estate boom on every cable news show that would book him, who made "Move to Florida" practically a campaign slogan, finally acknowledged the crisis in January 2025. He convened an emergency legislative session specifically to address the condominium crisis, admitting publicly that recent safety legislation had resulted in unaffordable fee assessments, pushing residents from their homes. That's a direct quote, an admission that the state created this problem without thinking through the financial consequences. Miami-Dade County tried to help. They launched a special assessment loan program, offering up to $50,000 per owner at below-market interest rates. Good intentions. But within 3 weeks, demand completely overwhelmed the system. Thousands of applications. Not enough funding. The county paused the entire program in August, leaving thousands of applicants in limbo, hoping for relief that may never come. The problem is this: legislation can't fix decades of deferred maintenance overnight. It can't reverse the insurance market collapse driven by climate risk that's been obvious to anyone paying attention for the last decade. And it can't bring back the institutional capital that's already reallocated to Phoenix, Nashville, and Charlotte. You can't policy your way out of structural reality. And the structural reality is that Miami has become too expensive relative to incomes, too risky relative to climate exposure, and too complicated relative to the regulatory environment. So where does Miami go from here? I've modeled this 3 different ways, and there are 3 realistic scenarios for how this plays out. Scenario 1, the soft landing. Prices drop another 10 to 15% over the next 18 months. That brings the median home back to around $420,000, which starts to look attractive to buyers who've been waiting. Inventory clears slowly but steadily. Buyers who've been sitting on the sidelines, watching and waiting, finally see value and step back in. Insurance stabilizes as carriers figure out new actuarial models for Florida's risk profile. Maybe the state creates a more robust reinsurance mechanism. Maybe federal flood insurance reforms make coastal properties more insurable. The state legislature creates a long-term, well-funded financing mechanism for special assessments, allowing owners to amortize costs over 15 or 20 years instead of paying lump sums. Miami becomes a normal market again, not the hottest market in America, just a normal, functional market operating at lower valuations. Sales pick back up. New construction restarts. The crisis fades into memory. Probability of this scenario, 20%. It requires too many things to go right simultaneously. Scenario 2, the long freeze. Sellers refuse to capitulate. They'd rather wait years than accept current market prices. Inventory stays elevated at 15,000 to 20,000 units. Sales volumes remain depressed at 40 to 50% below historical norms. The market enters a multi-year stalemate where nothing moves except distressed properties and forced sales from owners who have no choice. Miami becomes the housing equivalent of Japan's lost decade, where prices don't crash spectacularly, but they don't recover either. They just drift sideways for 5, maybe 10 years, while inflation slowly erodes real values. Nominal prices stay flat, but real prices, adjusted for inflation, drop 30% or more. This is psychologically brutal because owners feel trapped. They can't sell without taking losses they refuse to accept, but they can't win either because appreciation isn't coming back. They're just stuck, paying costs that exceed what they'd pay to rent, holding an asset that generates no return. Probability, 50%. This feels like the most likely outcome given seller psychology and the structural problems that have no easy fixes. Scenario 3, the cascade. Special assessments trigger a wave of defaults as owners who can't pay and can't sell simply stop paying everything. Foreclosures spike from current elevated levels to crisis levels. Banks take control of entire buildings and liquidate at whatever price clears the market. Those distressed sales establish new price comps that force other sellers to capitulate. If your neighbor's unit just sold in foreclosure for $400,000, good luck getting $550,000 for yours. The market reprices violently downward by 30% to 40% from peak. Miami goes from expensive to affordable, but the social and economic damage takes a generation to repair. Property tax revenues collapse, forcing cuts to services. Construction jobs disappear. Retail and restaurants that catered to wealthy residents close. The entire economic ecosystem that depended on real estate wealth contracts painfully. Probability, 30%. Higher than anyone in power wants to admit. All it takes is one major building facing mass foreclosure to trigger contagion. Here's what I believe is actually happening beneath all the statistics and scenarios. Miami-Dade is experiencing the first climate-adjusted real estate correction in American history. This isn't fundamentally about interest rates, though they matter. It's not about recession, though economic conditions matter. It's not even primarily about pandemic boom and bust dynamics.
This is about a market finally, painfully, pricing in the actual long-term cost of living in a place where insurance is becoming unaffordable, where infrastructure is failing, where the physical risk from hurricanes and sea level rise is undeniable, and where the regulatory response to that risk creates financial obligations that ordinary people cannot meet. Miami is the canary in the coal mine. Every other coastal market is watching, because what's happening here today is coming for Charleston tomorrow, for Tampa next year, for New Orleans, Virginia Beach, and eventually the entire Atlantic and Gulf Coast over the next decade. The question isn't whether Miami rebounds. Markets always rebound eventually. Even Detroit rebounded. The question is, at what price does equilibrium get reestablished? How far do values have to fall before buyers see opportunity that outweighs risk? And who gets financially destroyed while we wait to find out? 17 units for sale in one building. Nobody buying, nobody selling. Just waiting. That's Miami right now. A market in suspended animation, holding its breath, waiting for someone to blink first. I'm tracking every data release, every policy response, every foreclosure filing, every signal that tells us which of these three scenarios we're actually heading toward. If you want to understand what happens next in Miami, and what it means for coastal real estate everywhere else, subscribe right now. This story is just beginning. And drop a comment with your honest answer to this question. If you could buy a Miami condo at a 40% discount from peak prices today, would you? Or is the risk not worth any price? Because your answer tells me everything about whether Miami has bottomed or still has further to fall.